I really love passive income, and I think it's something to do with the physical side of money coming into your account every month. But on top of that, it's knowing that the more dividend income you receive and the more expenses it eventually covers, it means you are slowly buying more and more freedom for yourself in life. Lately, I've been enjoying investing in ETFs because I can set and forget and I can worry about other things while the ETF worries about my money. So I wanted to know, what are the best ETFs I can invest in for passive income that can grow and build that passive income over the years without me having to think about it? And I think I found them. So today I'll show you 3 dividend ETFs you can buy right here in the UK that over time can replace your entire salary. By the end, I'll show you the exact amount of money you'd need to never work again, and I'll crown the single best one based on the data. So let's get started. Now, I'm not a financial advisor, and this is not financial advice or a recommendation. Everything in this video is for information and entertainment. Stock prices and dividends go up and down, so please do your own research and speak to a financial advisor before making any decisions. Now, when you buy a dividend ETF, you're buying a whole basket of companies that pay out a slice of their profits in cash. That cash gets paid straight into your account, usually every 3 months, just for holding it. And for it to pay your bills or to replace your salary, there is a simple formula that you can use to figure out how much you need. So your annual income equals your total investment times the dividend yield. And inside a stocks and shares ISA, every penny of those dividends is completely tax-free. So for this video, let's say you want to replace a £30,000 salary, and we'll apply this number to all 3 and see how much you need for each. But just that number alone is not the full story, and I'll show you why. So 3 ETFs, and the first one we're looking at is the one that pays you the most today, and that is the iShares UK Dividend ETF, ticker symbol IUKD. This ETF tracks the 50 highest yielding companies in the UK market, names like Legal & General, British American Tobacco, BP, HSBC, Aviva and Shell. These are old, established British companies that hand out large amounts of their profit in dividends. Right now, it's paying around 4.5% dividend yield, the total expense ratio is 0.4%, and it pays you quarterly. So back to our £30,000 figure. At this yield, you'd need a pot of about £660,000 to bring in 30k a year. And that sounds like a lot, and it is, but I'll show you later a simple way to build that over time. But it's still the smallest pot size out of the 3, and now it starts to get a bit interesting. Next is what I'd call the all-rounder, and the most well-known of the 3, the Vanguard FTSE All-World High Dividend Yield ETF, and the ticker is VHYL. Instead of just the UK, this one is a global ETF. It holds over 2,300 high-yielding companies from across the world, developed and emerging markets, with names like JP Morgan, ExxonMobil and Procter & Gamble. So you're not betting on one single country's economy. If the UK has a rough decade, you've got the US, Europe, Asia and more to spread the risk. The dividend yield sits lower than IUKD at around 2.5%, and the fee is lower at 0.29%, also paying dividends quarterly. So back to our 30k. At 2.5%, you'd need a pot of around £1.2 million, so nearly double IUKD. But you're trading a slightly lower income today for proper global diversification, and more importantly, it has a bit more room to grow the share price. For a lot of people, this is the well-known, sensible, boring, set and forget middle ground for dividend income ETF. And often in investing, the boring ETFs can be some of the best over time. But now we get to the single most interesting ETF in this video, and it's something most people ignore and scroll past. But there's a big reason why you shouldn't. By the way, if you're liking this video so far, please take a couple of seconds to hit the like button below. It means YouTube will know to show it to more people, and I'd really appreciate that. Now, this is the WisdomTree Global Quality Dividend Growth ETF, or ticker GGRP. And right now, this is the ETF that pays you the least. And that's why so many people scroll past it and don't give it the time of day. But stay with me, because GGRP doesn't chase the highest yield. Instead, it targets high-quality global companies that are growing their profits and, crucially, growing their dividends year after year. We're talking about the likes of Microsoft, Apple, Broadcom, and Coca-Cola. So the yield today is low, around 1.7%. The fees a touch higher at 0.38%, and at first glance, the math looks terrible. To replace that 30k salary at a 1.7% yield, you'd need a pot of £1.7 million, more than 2.5 times what IUKD needs. So, why on earth would anyone pick it? Well, there's two reasons. The first is total return, which is the share price growth plus the dividends combined. Since this fund launched back in 2016, it's averaged around 12.3% a year, which has actually been a touch ahead of the other two. And second, and this is the big one, its dividend grows fast. And over a long enough time, the faster growing income can not only catch up to the higher yield, but overtake it on a big scale. Let me show you what I mean. Now imagine you put £10,000 into two funds. Fund A is the high yield one, paying 4.5% and growing that payout by about 3% a year. Fund B is the growth one, paying just 1.7% but growing that payout by around 10% a year. Year 1, Fund A, the high yield, pays you £453 and Fund B pays you just £177, so Fund A is the obvious winner. But in time, in the background, Fund B's income is snowballing. By around year 16, the lower yield Fund B catches up, and Fund B is now paying you more. So by year 30, Fund A is paying you about £1,070 a year, but Fund B is paying you over £2,800, more than double from the exact same £10,000 you started with. That's why, over the long term, dividend growth quietly eclipses a high starting yield. The tortoise catches the hare, overtakes it and laps it. Now, to be clear, those growth rates are an illustration, not a promise. Nobody can guarantee a fund grows its dividends at 10% a year for 30 years straight. But the principle is the same. Time rewards growth. But let's look back at those pot sizes. 660k, 1.2 and 1.7 million pounds. I know that sounds like a lot, and it definitely is. But you don't need to find that money. You can build it slowly and steadily over time. Because if you invested £500 a month and let it compound at around 12% a year, after 22 years you'd be sitting on around £660,000 for IUKD. And of course, if you invest more, the time would be less. A pot's throwing off around £2,500 per month in income, tax-free in an ISA from £500 a month. But of course, that's just an example and you can invest however much you want to suit your timeline. So the single best ETF for long-term passive income based purely on the historical data is actually the lowest yield with GGRP, not because it pays the most today, but because total return plus dividend growth is what actually builds the biggest pot size and the biggest income over 20 or 30 years. But honestly, we don't all want to wait 20 or 30 years, and if that's the case, I think VHYL is also a great option for a happy middle ground of decent income and good growth, and if you want higher income right now, then you can look at IUKD. But you can also hold one, two, or like a lot of people, you hold all three, because investing is there to serve you and what you want out of your finances. So there is no single right answer. There's only the answer that suits your financial goals. So there you have it. If you enjoyed, please remember to like the video and subscribe if you want to keep building your income and your wealth along with me. Let me know any questions in the comments and I'll see you guys next Wednesday as always on Casual Cash. Cheers.